makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. Maersk saying it's holding off resuming shipments through the Red Sea and oil off the back of it gaining as Iran sends a warship to the area. It all comes after the U.S. Navy destroyed 3 Houthi boats. And now at least 48 people now confirmed killed after an earthquake in Japan as fresh aftershocks continue to rattle the region. Plus, a Bloomberg scoop reveals ASML canceled some shipments of high-end chip-making equipment to China, all after pressure from the U.S. government, but before the sanctions took full effect. Let's take a quick look at the European markets map as, of course, investors digest what's going on in the first trading day of the year. It's pretty straightforward. Green on the screen is what you're going to see. But look, futures had already set us up for those kinds of gains. What's important to keep in mind, though, is that you are seeing some outperformance in some of the main indices. But again, it is still very light trading volume. No major positioning just yet. But it does speak to the idea that perhaps we are starting the year off on a good note. Remember, however, though, that January is tentatively seasonally a pullback year, just given year on year. Last year was a pretty big one, not just for the U.S. indices, but for the European ones as well. So again, waiting for more of that trading volume to kick in to see if that seasonality actually has an effect going into, of course, the first month of 2024. It all comes as we also digest the geopolitics in the Middle East as well, and what that means for the investor playbook. Iran has now sent a warship to the Red Sea after the U.S. Navy destroyed 3 Houthi boats over the weekend. The move risks ratcheting up tensions and complicates Washington's goal of securing a waterway that is vital to global trade. At the same time, Maersk, one of the major shipping lines, saying it's holding off on resuming routes through the area after a weekend attack on one of its vessels. There's a lot to digest there. Let's dive into it. We're joined now by Bloomberg's Sam Dagger, who's, of course, been covering the story very, very closely. Sam, a pleasure to have you on the program. Give us the latest from the Red Sea.
Sure, my pleasure. So we had Iran yesterday send this warship to the Red Sea in a show of force and support for the Houthis, whom it's been backing for almost a decade now. And it actually happened while a senior official in the Houthi movement was in Tehran. He's still there, as far as we know, meeting with some of the most senior figures in Iran's government. So it's a clear show of support. And plus, we had the Iranian foreign minister come out and say yesterday that Iran was supporting, the choices that the Houthis were making and effectively rejecting, calls by the West on Iran to rein in the Houthis. So really this adds to an already very tense and volatile situation in the Red Sea. You've got the U.S. there leading this multinational maritime force with 10 countries right now, at least the ones that publicly announced, including the U.S. and others who've said they would join. Denmark. I mean, it's worth noting that after the attack on the Denmark-owned ship, the Danish foreign minister told us in remarks email to Bloomberg that that Denmark was even more determined now to send a frigate to the Red Sea to join that coalition, because he said what was happening was a huge danger for global trade.
It's interesting you're talking about the Danish response. Even the Greek response has been pretty crucial because historically they've been 2 major shipping powerhouses. Sam, Bloomberg Economics said that when it comes to actual global trade disruption, when it comes into real translation into GDP numbers, for example, it would still take a sustained level of tension, months even, years even, to really see that show through. We're already a couple weeks into this conflict in the Red Sea. How much has global trade actually been disrupted?
I think it's hard to assess, but certainly, I mean, the longer this goes on, the more it's going to have an impact. I mean, remember, this is a waterway. We're talking about, the Suez Canal in the north of the Red Sea and the Bab el-Mandeb Strait, which leads on to the Gulf of Aden and the Arabian Sea and onward to the Indian Ocean. I mean, this is a waterway that accounts for anywhere between 10 and 15% of global trade. I mean, all the commerce between the Far East and Europe. I mean, most of Europe's energy needs, at least through the fuel tankers coming from the Middle East, have to transit the Red Sea. So this is huge.
I mean, it's certainly something that's already showing up in the market moves. You're seeing it on your screen right now. Some of the major stock market moves that we've seen off the back of some of the tensions that you just pointed out. Bloomberg's Sam Dagger there walking us through the crucial stories we need to know out of the Red Sea. And as he speaks, we're seeing Maersk higher by 3.7% in the European trading. A really strong start to some of these shipping margins that, of course, will then feed into their bottom line profits. But the question is how long when you're adding voyages that are 40% longer in distance, when you're adding more labor, more fuel. And that's going to be the question in terms of just how long this can sustain. Of course, the crucial story is how long do we start to see the conflict between Israel and Hamas really extend? And it brings us to a crucial story because it's not just an international one or a geopolitical story. It's certainly a domestic one as well. That's where I want to go next. Israel's Supreme Court has overturned a highly contested law aimed at weakening the power of judges. It's a ruling that's a setback for Prime Minister Benjamin Netanyahu's right-wing coalition. But it's a little bit of a complicated story. Let's get a little bit more analysis here. Bloomberg's Alyssa Ottenheimer joining us this morning. Alyssa, thank you for having us on the show. Talk to us a little bit about what the government was originally aiming to do.
Hi, Kriti. Thanks so much for inviting me. Well, it all began about a year ago. You have to understand that this government is quite right-wing in comparison to previous governments. And the Justice Minister announced that they're going to take the opportunity to make a big judicial overhaul, because what the government felt was that even though they have the votes to rule the country, because the Supreme Court is able to review and to strike down some of the moves that it makes, that it really isn't able to do what it wants to do. So, for example, in January, Netanyahu appointed a minister, and the Supreme Court ruled that even though there's no law against it, it wasn't reasonable. So the government decided that it would change one of the basic laws concerning the judiciary, and ruled that the courts could no longer use this reasonableness as a test of whether a government policy was okay or not.
But talk to us a little bit about the reaction now of the Supreme Court turnaround. And to your point, this has been something a lot of the international community has said this is kind of where Benjamin Netanyahu is crossing the line. Do you think this is enough, perhaps, to change that public opinion?
Yeah. So as you mentioned, the government law that was enacted in July had spurred all kinds of demonstrations, hundreds of thousands of people demonstrating week after week against it, mainly led by the left wing. Now, Israel's quite split down the middle between right and left wing, and the left wing protested against it quite a bit because they felt that it would give the government too much power. Now, what has happened now is that the ruling was given now because two of the justices are going to be retiring, and there's a rule that they must turn in all their rulings before 3 months has passed. So that's why they gave it. That's why they handed down the decision now. What's ironic is that the drama has been somewhat been reduced, because really the whole country is no longer focused on the judicial oversight law, but is really focused on the war with Hamas. So the government's reaction was, number one, why did you hand this down in the middle of a war? We want to try to keep the country united, and this is an issue that has divided the country, and why are we bringing it up again? But number two, the whole drama of the decision, I think, has been somewhat reduced, and it doesn't seem that the government will try to do anything about it. In other words, will try to enact another law because there's a war going on, and that's a lot more important.
It's certainly something that is creating a lot of mixed currents from someone viewing the conflict and the internal turmoil from the outside. Bloomberg's Alyssa Audenheimer, we thank you so much for bringing us that crucial context on something that could really change the trajectory of Prime Minister Benjamin Netanyahu as she laid out. Of course, that's going to be a story that we watch very, very closely, but let me bring you a couple of other ones as well. Starting in Asia, Japan's public broadcaster NHK says at least 48 people are dead after the powerful New Year's Day earthquake off the Noto Peninsula. All tsunami warnings have been lifted, though dozens of aftershocks are still rattling the region. And more than 30,000 homes have been left without power, but some areas still don't have running water. Meanwhile, in South Korea, the main opposition party leader Lee Jae-myung has been attacked during a visit to the southern coastal city of Busan. The Democratic Party's nominee for the presidential election in 2022 was taken to hospital with bleeding from his neck. Video of the incident appears to show Lee walking through a crowd of reporters when the attack happened. Now, much more to come. Stick with us. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta in London. Well, look, the consensus call for 2024 is that bonds are back. The bull market we've seen for the last 40 years or so, well, it's going to sustain. At least that seems to be the trend lines you see on the major chart. But the question is, for how long and with what kind of momentum behind it? Who better to ask those questions than Iain Stealey, International Fixed Income's CIO from JPMorgan Asset Management, joining us this morning. All right, well, if bonds are back, let's start with the numbers here. What is the floor in yields for the 10-year?
So if you think about just the surprise that we've had over the last few months and ending the year pretty much where we started 2023, but it is different this time around because the central banks have let the cat out of the bag that I think they want to be easing policy from where they are. They do feel that they're in restricted territory and inflation is coming down. And I wouldn't be surprised if we do go towards 3.5 in the 10-year, first half of this year, and then possibly even lower in the second half. But it will depend on the data. It will depend on inflation continuing to do what the central banks believe it will do. And then we could go even further if we see weakness in the jobs market.
And how do the rate cuts price into that? We're looking at 5 rate cuts priced into the market right now. The consensus among economists is that the markets are way too ahead of themselves. What would be the surprise rate cut call for you?
The surprise rate cut call would be that they actually end up doing more. And if you go back through history and take out the last cutting cycle, because obviously they only managed to get rates up to a certain level, but previous cutting cycles, typically the Federal Reserve's managed 250, 260 basis points in the first year. So you could argue that 150 that's priced at the moment is actually not a lot. Now, in those scenarios, you've obviously had a deep downturn, and they've had to react, and that most people are expecting a soft landing and these sort of proactive cuts. But the risk is that they could end up doing more.
But if that risk is then ending up becoming basically a tailwind for the bond market, I'm curious what reverses it. I mean, it feels like the no-brainer is obviously if the inflation data goes in the wrong direction. But what might drive that?
I think if you continue to see resilience. So the big surprise last year was the strength of the consumer and how well that held up and how the jobs market didn't deteriorate, and the fact that we'd had these 525 basis points of hikes from the Fed and pretty much every other central bank around the world, and we hadn't really seen it hit the broader economy. And if that continues this year, and that the Fed start cutting and we continue to see the jobs market do well and inflation doesn't fall to where they want it to and maybe starts to re-accelerate, that's the big concern. And if you think back to Q3 of last year, that's what we were discussing then. Now, that feels like it maybe was a bit of a blip, but if we reappear to that sort of scenario, that's going to be a concern for the bond market and concern for the central banks.
Well, Q3 of last year was traumatizing for a lot of bond traders simply because of the sell-off on the long end of the curve. But it brought about this question about how much volatility can the market really stand, given that it almost feels like the market is in control of rates, perhaps more so, or one would argue more so than the Federal Reserve, just given how much money is parked in on the front end of the curve. If we're talking about this built-in tailwind for the bond market, I'm curious about the volatility there. Do you see that easing in 2024?
I think the volatility does ease if you take away the fear factor for the markets, which is further hikes, further tightening from the central banks. If you get into the market gets into a mindset where the central banks are done and the next move is towards cuts, which is where we feels like we are at the moment, the reality is the volatility should come down. Now, I don't think it's ever going to come down to the levels that we saw post-financial crisis, pre-pandemic, when rates were at zero and we were doing QE and really flooding the market with liquidity. But we should see probably a little bit lower volatility than we saw last year.
But in terms of going into the presidential election and the fiscal deficit debates that we're going to be seeing in the United States, specifically that kind of rear its ugly head in January of 2025, so right when we get the results of the election, how do you price something like that into a bond market?
I think it's quite difficult, and it's probably likely to be more a second half of this year type pricing. I think the first half of this year will be more focused on whether the Fed is able to follow through on what the market's pricing from a cutting standpoint. But we have to remember there's a lot of supply coming this month across the globe, not just the US, but also within Europe. We saw this big rally in the bond market. So maybe bond yields have moved a little bit too low just in the near term. But for me, that might be a tactical trade. The more strategic opportunity is that actually the yields that you're getting on offer now within the bond market, if the central banks are done, if they're going to be cutting later this year, are looking attractive, and you should be looking to get invested in it.
Do we need to be worried about the plumbing, though, to make that happen when we're talking about how much supply is actually going to hit the market, how much supply is going to be digested by the market, given that the Treasury is still auctioning a pretty substantial amount of debt?
But again, if you think back to where we were, that was the big fear in Q3. And then obviously Q4, when people want bonds, supply gets taken down. And if you look at where the amount of money that's sitting in cash funds today, and if you can't guarantee that you're going to be able to continue to lock in those cash yields, and the concern is that you're going to be lower yields because of central bank easing, you want to be in the bond market, that should see money flow into bond funds, and then ultimately there's where your demand is.
But at some point that has to reverse, right? I mean, you're having major longer-term conversations, to be fair, from some of the major even investment funds around the world, some of the major countries around the world that have been longtime holders of treasuries. Wasn't this part of the fear of the sell-off that we saw on the long end of Q3, that people don't want exposure to American debt? It certainly didn't help when you had Moody's basically issuing a warning about the deficit issues. I'm curious about why that was maybe brushed off in Q4.
The brush-off was the data helped. Some of the supply announcements were more favourable, maybe not as much supply issues as people had feared. And then, say, lower yields. And if yields are going to be low and you'll be able to gain capital on your bonds, people want to get reinvested in them. And I think that's what we're going to see. I still think there's a lot of demand out there for bonds. I still think people, on average, are sort of underweight bonds. And a number of client conversations that I had last year was people weren't willing to go into the bond market until they had more conviction the central banks are done. Well, hopefully that's the case now, so they can take that leap of faith and go into the bond space. So I do feel there's going to be that demand. But what it probably means, to your point, is yields just don't go back to where they've been in the last decade. We're not going to go back to 1%, but we can go a little bit lower than we are today.
Oh, all right. So not 1%, but lower than 3.94 is where we're at right now. And I think you said about 3.5 in the first half of 2024. Iain Stealey, we have to leave it there. He's answered the rapid fire round of the bond market that I just gave him. International Fixed Income CIO from JPMorgan Asset Management there. We thank you as always. Look, there's a lot coming up, and we're going to go right back to the geopolitics of it all because those stories are developing. Bloomberg learning that ASML has now canceled shipments of some of its machines to China ahead of the export bans. We're going to bring you the details next. Stick with us. This is Bloomberg. Now, Bloomberg has learned that ASML canceled shipments of some of its top-of-the-line chip-making machines to China at the request of the United States before export bans had actually come into effect. It's a crucial story, an ongoing one for the world's largest chip maker, or chip equipment maker, I should say. Bloomberg's Sarah Jacobs is in Amsterdam to bring us the story. Sarah, why did ASML do that?
Hi, good morning. So Europe's largest tech company, ASML, cancelled shipments of some of its machines to China at the request of U.S. President Joe Biden's administration. That's what our sources are telling us. So U.S. National Security Advisor Jake Sullivan, we are told, called the Dutch government late last year and spoke to them about this matter. And Dutch officials, asked the U.S. to directly speak with ASML regarding the shipment of the machines. And the machines are called immersion deep ultraviolet lithography machines. So that resulted in the Dutch government then partially revoking licenses recently for some of these certain advanced machines to China, and that affected a small number of customers there.
And of course, we know it puts the Netherlands in the middle of two of the largest economies in the world. Geopolitical tensions that we know have been going on for, well, years, really. But of course, in the last, I think, 2 months or so have kind of sustained. We'll see where Netherlands falls into that with, to your point, the largest tech company in Europe. Bloomberg's Sarah Jacobs in Amsterdam, we thank you so much for your reporting this morning. And coming up, we stick with the emerging market story. Remember, the de-dollarization story, still extremely important when it comes to what the trade is in 2024. Well, it looks like the BRICS Club is now going to be doubling its membership. More what that means for global geopolitics, for trade, for the dollar, all of that analysis and more coming up with a true expert on not only the current BRICS members, but the new ones coming up in the block. We're going to dive into really, again, the geopolitics, the trade, the markets. This is the story that matters for 2024. Stick with us. This is Bloomberg. Maersk says it's holding off resuming shipments through the Red Sea as oil gains amid Iran sending a warship to the area. It all comes after the U.S. Navy destroyed 3 Houthi boats. And at least 48 people now confirmed killed after an earthquake in Japan. Fresh aftershocks still rattling the region. And a Bloomberg scoop reveals that ASML canceled some shipments of high-end chip-making equipment to China after pressure from the American government. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. A lot to digest there, but we are getting some headlines breaking, this time coming out of Japan. It looks like a JAL, Japanese Airlines aircraft, has now collided with another plane after landing. That's, of course, according to the NHK, their national public broadcaster there. It looks like passengers were on board when the accident has occurred. You were looking at live images from Tokyo, of course, of the fire being put out. As we get more information, we, of course, will bring them to you. But for now, these live images and the headlines that we're getting coming from the national public broadcaster NHK live out of Tokyo, where it is about 6:30 p.m. local time at the moment. Of course, the fire also seen largely from the airport. Unclear whether or not there are any fatalities or injuries. We, of course, will keep you apprised as we know. I want to move on to one of our top stories here. Ukraine says it shot down almost 90 Russian drones on New Year's Eve as the war grinds towards its third year. It followed Russian missile attacks over the weekend that killed at least 30 people in Ukraine. Joining us for more on this, Bloomberg's Piotr Skolimowski all over the story. Piotr, it's a very dim, it's a very tragic anniversary that we're headed to. Walk us through the state of play.
Yes. So we had a fresh attack today, actually. There was a missile attack coming from Russia again. And around more than 20 people are wounded. The attack mostly affected Kiev, but also was targeted at Kharkiv. So the big cities are again being targeted. What we're seeing over the last few days, actually over the last week or so, is that there's an intensification in terms of the air warfare. We've been hearing so much about the fact that in terms of the ground offensive, things have basically ground to a halt. We heard so much about the stalemate. Meanwhile, what we're seeing right now is that in terms of aerial warfare, this has really intensified. And it started with, actually last week, with Ukraine allegedly destroying a landing ship that Russia had in Crimea. And since then, things have really gone into tit for tat. Ukraine again hitting Russia's town, or at least Russia claims it hit its town Belgorod on the border with Ukraine just a few days ago. There was a massive strike just before the new year, affecting a lot of residential areas across the country in Ukraine. And obviously, we heard yesterday from President Vladimir Putin, who said the attack on Belgorod amounted to a terror attack, and he pledged that he will attack, and there will be more attacks from Russia, and they are indeed coming today. Obviously, we have to remember that Putin is facing election in March. It's not, and that's not, he has to project this idea that he is in charge, and the fact that we're having so much activity in the air suggests that he's going to intensify attacks, especially that Ukraine seems to be a bit on the back foot, in fact, because of the fact that Western aid is blocked, or some of it is blocked. So the country is calling on its allies to provide more aid in terms of financing, in terms of weaponry.
Again, a very dire and tragic situation you are seeing in Ukraine, a lot of which the future depends on some of the aid you are getting out of the U.S. and Europe as well, where at a time the politics really just not working in that favor in both regions. Piotr Skolimowski, we have to leave it there. He's our Bloomberg Warsaw bureau chief, bringing us that live reporting. And look, as a piece of the conflict you're seeing in Ukraine and now in Israel as well, from an investor standpoint, there's a lot of concern about how much exposure you want to the conflict, especially those specific regions, which have now, by the way, become a part of the BRICS group. That is the latest developments from out of the Middle East. Membership of the BRICS group of emerging market nations doubling. Saudi Arabia, the UAE, Iran, Egypt, Ethiopia, all officially joining the group. On the other hand, Argentina declined an invitation for membership. Now, the expanded bloc pairs some of the world's largest energy producers with, by the way, the exposure to those tensions with some of the biggest consumers among developing countries. I'm joined now by Pallavi Roy, an associate professor in political economy at SOAS University of London. She, of course, joins us from Calcutta, India this morning. Pallavi, a pleasure to have you on the program. Thank you so much for joining us, and Happy New Year to you. Let's start with the significance of this move. Talk to us about in the context of de-dollarization. Argentina's Javier Milei has been very vocal about de-dollarization and yet not really touching this particular partnership. Where do the newest members of the BRICS group stand on that?
Well, it's an interesting question that you begin with. Argentina's new president has certainly been very vocal about de-dollarization, but what's also important is diplomatically, he has been very clear to signal that he is not as anti-Western as the BRICS compact actually is really trying to project with this expansion. So even though he has been talking about de-dollarization, it'll be on his terms, whereas the BRICS, it's not just looked upon in terms of the economic aspect of it, which is the de-dollarization aspect of it. Much of it is actually the geostrategic signaling that the BRICS group actually now wants to inform the high-income, Western bloc about. This is the BRICS grouping is really essentially something that's far more geostrategic than just about the economy or about de-dollarization. So to me, this is much more informing the Western bloc, the high-income Western bloc, if you so wish, that we can take in the kind of members, for instance, Iran, for instance. I think this is a really excellent signaling mechanism which says, you might shun, but we are prepared to take on board, members of the international community and countries that you will not do business with. So to that extent, de-dollarization is not front and center, but the BRICS countries, and certainly even in some members of the BRICS Plus, have been talking about looking at an alternative to the dollar. And what's interesting is you did bring up this idea of a large number of consumers in the BRICS Plus countries. But if you look at it with this new accession with UAE, with Saudi Arabia, with Brazil, with Russia right now, what you actually have is the grouping will enjoy about 43% of the world's oil production, up from 20%. And this is where things could get really interesting. The choice of countries really seems to represent an energy compact, and that allows them to be less vulnerable to risks in oil trading, allows them to trade in their own currencies rather than, I'd say, directly about de-dollarization. So that's an important point to pick up. You could trade in rubles, you could trade in yuan. It actually becomes easier to trade in Iranian oil, and this could be a sticking point for the West. So to me, it's a lot more about the geostrategic signaling than just about primarily de-dollarization.
Pallavi, you bring up an excellent point because you've already actually seen that dynamic, especially in terms of oil flows between the likes of Russia and China or Russia and India, for example, where you have seen those alternative agreements actually taking place. But I'm curious about what kind of precedent that sets then for other kind of commodity trades. I mean, South America in particular, a lot of these BRICS countries, India, Brazil even, are known for their agricultural exports. So this dynamic you're seeing in oil, does it extend or expand to other commodities?
that is a wait and watch. There's a lot of iron ore also, for instance, between, there used to be a lot of China imports to China from India for iron ore. Brazil, a big iron ore exporter, China, huge iron ore consumer, and the Indians are trying to get their iron ore trading in order recently. So certainly this could at some point be extended to other commodities. But I would think that this is much more about the energy compact with oil diplomacy actually becoming a big part here. In terms of whether these currencies, and the other aspect also is whether these can be globally traded currencies. But apart from China in the BRICS and the BRICS Plus grouping, there really isn't any other country that accounts for more than, let's say, 3 to 4% of world trade. Even India, which is one of the largest economies in the BRICS Plus grouping, accounts for about less than 3% of world trade. So that to that extent, it will be displacing the dollar, perhaps in the trading that happens within these countries. But whether it displaces the dollar completely, I think that's really still very far off. And also do think about the fact that all these countries, without exception, do not have what we call a full capital account convertibility. And unless that happens, it's going to be very difficult for them to displace the dollar and then become fully convertible and tradable to replace the dollar. So to that extent, no, it's not going to happen.
Getting very, very nerdy very quickly. I love it. A final question to you. I want to, in our last minute, ask you about the response that some of these developed economies are getting. It's not just an American story, it's even a European one. In our last minute here, what does that look like?
Sorry, could you repeat the question? I have a slightly dodgy broadband connection here.
No worries, no worries. Happy to. What is the response then from the developed economies, from the United States, from Europe, in the face of this really growing partnership you're seeing in the EM world?
I definitely think that the Western bloc cannot ignore the BRICS and the BRICS Plus grouping. Like I said, it's much more a geostrategic grouping. These are influential economies. It might seem on the face of it that China is the biggest elephant in the room, but the others are actually increasingly becoming middle-income powers. There's India, there's Brazil. There's Saudi Arabia, which has been really flexing its muscles now and trying to strike out very independently as a country that's not really part of the American Defense Compact anymore, increasing relations with China and Russia. I think the West, before the entrance of Iran, had been strategically welcoming of the bloc as a kind of balancing act. But the entry of Iran is going to make things a little awkward for the Western powers. But then again, if you look at where the Western powers stand, especially with the IMF, with the World Bank, in terms of being a sort of financing powerhouse, there is still very little, certainly in the short to medium term, to replace that heft that the West has with the kind of financing that the BRICS Plus and the BRICS grouping actually also thinks of having. So the West will not want to ignore it. Indeed, it should not ignore it. But whether it sees a real and present danger in the immediate short to medium term, I doubt that the West will be very worried. But it's one to watch out for sure.
Right. Yeah, not to mention the internal dynamics within the Middle East as well. Think of Saudi versus Iran or Iran versus Egypt and how that all plays out. A fascinating topic we can go talk about for hours, but Pallavi Roy, we have to leave it there. We thank you so much for joining us. She joins us from the SOAS University of London, but of course this morning from India this morning. I want to bring you a quick update on some of the headlines we're getting out of Japan. At the start of the segment, it talked about a Japanese airline plane with a few hundred passengers. It looks like about 400 passengers and crew were on board the plane. Had collided with another plane as well at Haneda Airport in Tokyo. This all coming from NHK, the national broadcaster there. It now looks like all passengers and crew on board were evacuated, but you are looking at live images of a fire that still has yet to be put out, and we still, of course, don't know the real cause of the collision and the full extent of the damages. As we do, we will bring you those headlines right here on Bloomberg. Plenty more to come for the geopolitics and the markets. Stick with us. This is Bloomberg. Saudi Arabia's public investment fund was the world's most active sovereign investor last year, as Singapore's GIC and Temasek slashed its spending. Data from consultancy Global SWF shows that the PIF deployed more than $31 billion in 2023. In total, state-owned funds invested $125 billion last year, down by about 20% from the previous 12 months. Our Riyadh Bureau Chief Matthew Martin joins us now. He's been all over this story. Matthew, do you continue to see this momentum in 2024, or is this all in the rearview mirror when it comes to the PIF?
Yeah, I think, look, absolutely. I think we're going to continue to see the PIF being very, very active, both internationally and domestically in 2024. Last year, I think it was very much sort of, following in the tailwind it had from high oil prices in 2022, which enabled the government to give the PIF more firepower to go out and invest. This year, I think, there's a sense that we might see the theme shifting towards domestic investments as the PIF looks to sort of help execute on a lot of the diversification and investment projects to diversify the Saudi economy away from oil. But that being said, I think the Crown Prince Mohammed bin Salman has shown that he has a pretty high risk appetite and is prepared to make very big investments, prepared to give the PIF a lot of capital to go out into international markets, so that the PIF and Saudi Arabia more broadly become viewed as this real investment powerhouse and a real key player in terms of international capital markets. And that's where he wants to see the PIF positioned. So I think even if we do see a shift towards more domestic investments, we'll still see the PIF play a big role internationally as well.
But does that change when you look at some of the geopolitical tensions as well when it comes to investor exposure to not just Saudi Arabia, but the broader region? Is that an issue?
Yeah, I think, the political tensions that we have in the region right now are clearly going to be weighing on big global investors as they look at the region, and as Saudi Arabia increasingly tries to capture a bigger slice of any investment coming into the region. The fact that it's a region that looks increasingly unstable. It's a region that looks, increasingly sort of at the centre of a lot of these sort of problems going on in the world. We've got, the Red Sea tensions ratcheting up there. The continued Israel-Hamas war. Iran continuing with its nuclear weapons, nuclear program, and the skepticism about whether this is going to lead to Iran developing a nuclear weapon. This is all going to be weighing on big global investors as they make decisions to put money into the region.
A truly intense time, I have to say, for the Middle East, especially in the context of some of the geopolitical conflict that we are seeing, but also at a time when the Middle East is growing incredibly quickly, as shown by the PFIF's pretty substantial gains in 2023. Bloomberg's Riyadh Bureau Chief Matthew Martin, we thank you so much for bringing us that crucial story. And we, of course, go from Saudi Arabia to the natural pivot, which is space, and specifically space in the UK. The UK is struggling for liftoff in its dream to become a space superpower. It's all as political disarray and weak funding undermines the country's industrial strategy. In 2023, Britain's top satellite powerhouses Inmarsat and OneWeb were absorbed by overseas rivals. It's a crucial story, again, in the context of the geopolitics and the wars that we are seeing around the world. Bloomberg's Thomas Seal is all over that story. Tom, the space race continues, apparently, 40, 50 years later than the original one. Why is the UK trying to become a space superpower now?
Yeah, it's a great question. It's really a new space race after the 60s and Sputnik and Neil Armstrong, and it's driven by this increasing commercialisation of space, cheaper electronics, much cheaper launches, and there's one man who's really driven that more than anyone else, which is Elon Musk. His company, SpaceX, the satellite part of that, Starlink, has redrawn the satellite industry. SpaceX's rockets have totally changed the economics of launch, and everyone's trying to get in on that. At the same time, we see with the war in Ukraine, it's become very strategic to own some of these assets and to control some of these assets that allow new kinds of communications that can't be disrupted as easily. We see the Ukrainian military relying on Musk's Starlink. So Britain saw that, and it's trying to get in on the race, but its success, I'd say, a few years into this, is mixed as the piece goes into.
And, of course, there's a lot of concern then about what it is like for a private owner like Elon Musk to be owning technology that could be changing the course of massive wars that, again, reshape the entire conflict. It's not just about, of course, rocket ships, for lack of a better term. Talk to us about some of the challenges there, though. I mean, the UK, it feels like, is trying to put their hands in a little bit of everything, trying to gain some sort of edge. Give it 10 years, for example. Do you think they can actually make a dent?
Yeah, to be fair, my piece, I don't want to be judging things too early. It's a long race. I think the UK has a seat at the table where it didn't necessarily, that wasn't guaranteed. It bought out of bankruptcy in a very surprising move during the pandemic, this company OneWeb, which is really the only active constellation of low Earth orbit satellites to rival Elon Musk's Starlink at the moment. That's now been absorbed by a French company, and so the UK has a smaller stake in that. And so there's a bit of tension with the European Union about how that's going to be used going forwards. And then on the launch front, about a year ago, the UK had a much vaunted plane launch of satellites, which failed. And that was Virgin Orbit, Richard Branson's company, and that then filed for bankruptcy. So, that was unfortunate and did not help the sort of the public image.
Yeah, it's a really fascinating story. And again, as we know that Rishi Sunak and some of his peers have been trying to attract that tech investment, I imagine defense goes hand in hand, as does, of course, the space program. Bloomberg's Tom Seal joining us for the crucial update. Look, it really extends to a variety of different sectors, and it's going to be something we're monitoring in 2024, alongside some of what Wall Street is actually expecting. We're going to bring you the analysis next. Stick with us. This is Bloomberg. In 2023, some of Wall Street's biggest names getting it wrong with their predictions for how the markets would perform. Are they going to do any better in 2024? Well, Bloomberg has compiled more than 650 calls from strategists in today's Big Take. Our senior markets editor, Sam Potter, joins us now with more. Dare I say he's memorized all of them? I won't question him on it, don't worry. But Sam, talk to us a little bit about perhaps the call that most people might get wrong. What's the contrarian call that stood out to you?
Well, the interesting thing this year has been this sort of broad consensus for a mild slowdown, interest rates finally starting to bite, and then central banks pivoting to rate cuts. So I would say that the outlier calls, the ones that stand out are really the extreme bears. There's more bearish outliers than there are bullish, which I think underlines the downside risks this year with the US election, with the state of geopolitics. So someone like Rebecca, the Dutch quant outfit, really stands out to me. They described the consensus for a soft landing as being a fairy tale, and Deutsche Bank also prepping for a hard US landing.
You know, it's a really fascinating story and one that I wish we had more time to deal with. Bloomberg Sam Potter, I'm sorry we have to leave it there. I'm putting you completely on the spot in terms of the contrarian calls. But he said it right there. A lot of the concerns are going to be around basically the soft landing or the hard landing. It's the big debate. Some might even throw in the fact that there's no landing at all. What does that even look like when you price in the markets when over and over again, people keep saying that the biggest risk, the biggest inflationary risk, we just had Iain Stealey over at JPMorgan join us this morning saying the biggest risk is that consumer resilience. Do we see more of that going into 2024? At least that seems to be some people's bear case. Up next, I'm sure it's going to be largely discussed. Bloomberg Brief with Danny Berger in London and Maersk Craney in New York. They're going to set you up for the U.S. trading day on this first day of the year. Happy New Year, by the way, from myself and from the team. Plenty more ahead. Stick with us. This is Bloomberg.